Good morning. Oil prices are higher, and high oil prices are not good for the stock market overall. At least if I look back and look at the years when oil prices have been really high, it tends to put a lot of downward pressure on overall the stock market. Certain industries will flourish. Obviously, oil companies are going to make a lot of money. So that's fine. But oil companies are not a major part of the stock market. Growth stocks in technology, communication services, consumer discretionary, financials, those stocks will have a lot of pressure on them. We could see a pretty solid bear market if we have high oil prices. That's just the nature of where things go. If you look at the 5 year, the last time we were above $100 per barrel, right now we're $102.98. And the rise has been very dramatic from Friday the 13th. Look at that.
Mhm.
You know, I'm not all that bought into Friday the 13th being bad, but now I'm like beginning to rethink that. And we started then and we are up to $102 now. And the dramatic rise, I mean, when's it going to stop? Are we going to hit 150? I mean, that's not out of the situation. Okay. But I don't want it to do that because overall, that's going to be disastrous. Um, Oil prices, I mean, it's a pretty easy economics. I live in Southern California, and our gasoline prices are higher for a couple of reasons that I won't get into. But the long and the short of it is a month ago, it was $5 per gallon to fuel up your car. And my wife was telling me yesterday that there's an area in the Los Angeles area or county that is now selling gasoline at $8 per gallon. Okay. So we have an SUV, and that SUV, I think, takes 25 gallons of fuel total to fill up the tank. So at $5 a gallon, that's not a cheap proposition, right? Let's imagine I was completely empty, which is not the case, but just for the example, 25 gallons, $5, right? I get done fueling up and I'm well over $100. I'm up at $125 if I did the math right. All right. So now I go to that gas station in LA that is at $8 per gallon. $200 to fuel up. That's a lot of money. Um, and you know, if I needed to drive my car around quite a bit, which we do, fuel up maybe 2, 3 times, let's say 2 times, it's $400 a month. So those economics are easy to understand. So where's that $400 coming from? Well, it's coming from discretionary spend. It's really affecting the confidence of the consumer because the consumer is going to pause and say, "Whoa, am I going to be able to afford all the things that I'm accustomed to, the things that I like to have?" So all that is where we're headed with high oil prices. And you know, behind it is a war. And me personally, I don't think I think most people feel that war is a very bad thing, and I certainly feel that way because there's a human cost to it and there's suffering involved. So I don't want to just totally talk about economics without pointing to the fact that that's why this is happening. It's going to be a bad situation in the Middle East. So that's what we're waking up to on a Monday. I wish the news was different. I wish we were talking more about earnings that are coming up this week. There's a couple of interesting ones that are coming up. I wish we could talk about the earnings that happened last week. That was interesting. But when we have such a big um, causal factor affecting the whole market, it's almost like, hey, we plan this beautiful wedding. You know, it's going to be outdoors in a really beautiful setting, and it rained and it poured rain. Well, it ruins the whole thing. The plans were great. Caterer was the best caterer you could find. The cake was fabulous. The baker did a great job. The bride looks, you know, great. She got really good dress and all that stuff. but it's pouring buckets. It's going to ruin the wedding. And that's a little bit of high oil prices are going to affect the stock market. There's some businesses that are doing really well. They're growing. They have a grasp on what their customers want to have. They have a grasp on where things are growing and moving towards. And the long and the short of it is, for me, my point of view is that in 2022, there's a couple things that were playing out. First, it was not fun to look at one's portfolio. You worked really hard for your money and it's going down and you're like, oh man, this is brutal. I think the S&P was well down over 25%. It was 25.6 or something. So it was very hard to look at your portfolio. But if you continued to study, analyze, and kind of look at the businesses that you would like to be an owner in, you could have bought great businesses during this time. Meta, Netflix, Google. I mean, just go down the list. A lot of the most desirable businesses that we all could like pretty much point out. Like, here are the 20 best companies that, just have really good businesses. They're going to be around for a long time. You would have made a boatload of money as this thing recovered. So, that's where we're sitting at. Again, it's kind of it's tough information to deal with, but let me pause there. How you doing this morning, Daryl? Sorry to start on such a sour note, but what's your feeling on oil prices? Any thoughts you could share?
I'm doing good, first of all, and hello, everyone. It's good to be here. So I did notice that oil had popped up to as high as $116 in the pre-market, but then we pulled down to the 102 that Victor was just showing. So I like to keep an eye on, potential levels of the S&P. I can't do anything about oil prices. The only thing I can do is react in my portfolio to what's occurring, but I have zero control over what oil prices are doing. So I like to get a peek at where the S&P might go. So we hit our high on January the 28th. We closed, let's see, we had a high of $7,002 on that particular day. We closed at 69.78. So that became our resistance point. We've been just cycling in between that and this lower resistance point. It was a support level, but we came down and touched it on the 3rd, and we closed on Friday below that level. So now it's a resistance level. It almost closed at this next support level, which would have been set on the 17th of December. And I've also added this 150-day moving average, and it is just slightly above this support level, and we closed probably $1 or $2 just above that 150-day average. So that's one point we need to watch. So Victor mentioned 25% pull down in 2022. So we are down a whopping 3.5% at the moment. So where could this thing go? I mean, we have the 200-day, which is currently sitting at 65.82. That's kind of an eye test for me there. And we also have this level that was set on the 10th of October, was tested on the 20th of November. The 200-day is above that level, so that could become another support level.
Mm-hmm.
I'm going to show you one other chart that I used during the April pull down. Here, this was in April. I was posting these charts every single day. So what this is an anchored VWAP, which stands for volume weighted average price. Usually that's the volume weighted average price is only good for the day you're trading in. But if you anchor it to a specific date, then you can look at the prices based on the volume that was trading from that particular day. So I updated this morning, and we're still quite a ways above the low that we set on October the 7th. And this purple line here is the volume weighted average price for all the trades that have occurred since that day. And it currently has a price of 64.35. So a lot of people, when I was posting these charts, says, no way it's going to go down to these lines that you have set here. But look what it did. It blew through all of them to get to its final low. So I like to look at these, especially when we're in a environment like this where we're expecting somewhat of a pullback. So
I have a question when you can take it.
okay, so I'll probably be updating these on my own. I won't be sharing them unless something exciting starts to happen. But these are the dates that particular VWAP line is attached to at that particular low. Okay, go ahead with your question.
So if we go back to April of 2025, it really was a V-shaped, recovery of
Yep,
stocks. We went down fast, we recovered fast.
yep.
Now, fast forward to what we're dealing with in 2026, it doesn't seem to be. It just seems to be a consolidation pattern where it's like not. It doesn't have a committed direction or a clear direction. So we're kind of grinding lower. Does that mean that eventually, once we have these issues cleared, it's going to grind higher? Or what do you expect once we see a recovery? What's it going to look like?
Well, I've been sharing since October of last year. I expected volatility in the first 9 months to 10 months of this year. We've certainly had that. And that I expect the last quarter of the year to somewhat push us up to higher levels. So that was my thesis and going in proposition for 2026 back in October. I kind of still feel that way, but I'll just monitor, the charts as I see them, and let that help direct any changes I make in my portfolio.
Okay, and I would like to request we talk about the VIX, but I didn't want to interrupt your flow. If you wanted to talk about other stuff, go for it. But I did want to talk
Yeah,
about the VIX.
we'll go. Let me just mention the put call ratio on the S&P 500. So we did see a jump up in the raw data, which is this gray colored line, and then the darker blue line is the 5-day average. We're sitting quite a bit above what is typical, and we've been above what is considered typical since the end of January. So let's go look at the VIX. So we're at levels at the close on Friday that we haven't seen since the 3rd of April, which was the day after the tariff announcements, excuse
Mhm.
me. So we haven't seen levels since that particular time. And, for the last month or two, we've been talking about this ever
Yep.
increasing growing level in the VIX. It, will go up and then come down, but we have low or higher lows and higher highs. as we've been moving through this range since the end of December.
And can you explain what the VIX is, please?
So this indicates the amount of volatility that's expected over the next month. It's set by market makers. So they're the ones that set the prices of options, and volatility is a input into the calculation of prices for options. So they're expecting on an annualized basis about 29% volatility over the next month.
Mhm.
If you divide that by 12, it would give you the monthly number, but this is an annualized number that they report.
Ooh, 29% is a big number. So we can go up 29% or down 29%.
So this is a market maker's number,
Uh-huh.
and this put call ratio, this is what stock market participants are doing. So the
Mhm.
VIX is market makers. This is set by people doing the trading.
Okay.
You know, what actions they're taking. Are they buying more puts
Uh-huh.
or buying more calls? And buying puts is insurance. The higher this goes, the more insurance that people are doing. And as the VIX goes up, the price of that insurance also goes up. Price
Oh,
of
man.
puts and calls go up.
Okay. Interesting stuff. Excellent. So I'm looking at, the prediction markets. Let me show this. This is Kalshi, one of the two, right? There's Polymark and Kalshi. And now they have a prediction. How high will WTIL get by December 31st, 2026? I don't like this at all. Above 135 or above 130. It's pretty good odds that we're going to hit those levels. I don't like it because I think it's going to be really hard on portfolios. It's not going to be a fun year if we have high oil. It's a year where we can make a lot of money, but not in 2026. You're going to make a lot of money in 2028, 2029. And I know that that's you know, it's a long-term, plan. It's a long-term strategy. It will be factual that, hey, if we have high oil prices, we're gonna see a lot of pressure on the stock market and we're gonna see low stock prices. So if the one thing I would share is, depending on where you're at with your investing, if you're an investor that is beginning you're beginning your career, maybe towards the beginning of your career, and you are working hard, you're accumulating capital, you're constantly putting money into your savings, your 401k, keep at it. If anything, if we have a bear market, it's a great time to make some more money. Figure out how you can make more money. You can work overtime. That's great. And because that money that you put in is going to do great. This is last time we had a bear market. If you put money down, in general, if you just put it in the S&P, you'd be up 83% from that point to this point. And if maybe your timeline is, hey, I'm in the middle. I've been accumulating capital, accumulating a really nice portfolio over the last 20, 30 years. That's where we begin to think about, okay, how should we deal with potentially a bear market? And what I would share with you, what I'm doing, not financial advice. It's just, how do I deal with these things? There's, I, I'm slower in investing. I'm more careful. I want to see some things play out. Like one thing that's playing out is the whole software space has just been really sold off and it's beginning to show signs of going higher. Well, I'm not jumping in headfirst. No, I'm kind of waiting. And the reason I wait is reasons like this, where, well, middle of last week, it looked neat that, hey, looking at the 1 week S&P, software stocks are beginning to go higher. Well, that's great for 1 week, but now that we have higher oil prices over the weekend, is it going to halt this rally and take it lower, right? So as I execute my plan, it's just a little more patience. Cash is going to begin to look real good. Those low risk investments are going to start looking real sexy. Like, wow, man, you can make 4 to 6% there and not be hit by some of this volatility. The higher oil prices are going to affect technology. Let's take a look at the year to date and see how we're doing. The year to date doesn't look perfect, right? We got Nvidia is down a little bit. Microsoft's down 15%. This is just 2026. You see what's happened to software stocks. Google's down a little bit. Meta's down. The financials are down. And these guys are dealing with, I think there's some credit that is some debt that is affecting the private capital markets, and it's impacting them. And it's beginning to show. I remember Jamie Dimon at JP Morgan. What was the term he used? Cockroaches. If you find one cockroach, it means there's a bunch of them. And he was talking about bad debt. And guess what? He was right. They're finding other cockroaches, and it's beginning to affect the space. Well, that's bad. And if you have high oil prices, are people going to want to buy new stuff and refinance it? Or are businesses going to want to expand? Well, businesses are going to want to hunker down. Hey, my input costs really went up. So financials is going to struggle. Consumer discretionary is going to struggle. This is going to be really hard on, especially companies that have discretionary product. They're going to struggle. I don't know about industrials. It's kind of a mixed bag, but for sure, they're going to face some headwinds. Staples should do well because these guys, this is where scared investors out of all these sectors are going to run to Staples. And of course, energy is going to do well. This is the one sector that's going to flourish during a high oil price era. Healthcare could rally, but man, every time I think healthcare is about to have a long-term appreciation run, I'm wrong. It has a good month and then it goes back to getting taken down. So I don't know. This is a question mark. It could go higher, could go lower. I know that I could find some really good growth stocks here that make a lot of money, and I'm going to keep doing that. Materials, it depends. Is that a precious metal? That could go higher, but is it a commodity that needs the economy to be growing? Well, that commodity is going to be taken down. Utilities, I think, are going to receive investors because it's safe. And I don't know about real estate. Real estate's kind of like 20 question marks on it. I was looking at real estate this weekend, like looking at an apartment building and looking at multi-unit properties. They're so freaking expensive. It's like, man, you got to really pay up for real estate. And you have investing alternatives, right? I could invest in stocks, highly liquid, get in and out. Real estate's very hard to get out of. Okay. You buy it. You have to find, if you want to get out, you have to find a buyer. It takes a long time. It's expensive to get in. It's expensive to get out. So I think real estate, I don't know. It seems really, really like a bad investment right now. It doesn't measure up like some of the returns that you expect on these real estate investments. The cap rate, as they call it, they're promoting like 5.5%. I'm like, I do way better than that in the stock market. So I could do that cap rate in a very low risk bond investment. So why am I going to subject myself to that type of, risk of locking in my capital, big capital, by the way? You can't buy these real estate assets for, $1,000. You got to invest big. So I'm still pausing. I'm waiting for something to resemble 2008, 2009, 2010 when real estate would look great because nobody wanted to buy it. So that's where we're at. It's that's what we're dealing with. Now, let's get into some stocks. I have one stock in mind, but wanted to receive your request or topics. If you want to keep talking about topics, that's cool. I think we're open to that. Looks like Shadow Guy is on. Good to see you, Shadow Guy. Zubio, good to see you. And Henrik, good to see you. Good time to be a Norwegian. Yeah. Yeah. I think if your economy is good part of your economy is in the oil industry, you're gonna do great. Especially since you're completely away from the area of conflict. So Intuit, man, I'm a broken record on Intuit. I just think the business is awesome. I think it's a great business, and I've got a pretty good investment in it. And if it were to go lower, I'd buy more. But not now. I'm waiting. Now I'm totally waiting. I'm like really slowing down because again, we got to see what's going to happen with oil prices. How can it get worse? Yes, like back when in the 2000s, I want to say that we touched above $200 per barrel, and it could get really high and really ridiculous. So up here, this is 2008. No, my memory was wrong. $140 a barrel in 2008. That was high, and it stayed high. Look how high it stayed. 2010, that was a great recession period. So this is recessionary period, and 22 was a real tough year. And I think that in 2022, the economy officially, I don't know that we entered recession, but I believe that reason we didn't enter recession was that there was so much government stimulus due to COVID. Like we were pumping money into the economy. I think airlines were receiving a lot of funds from the government. Hospitals definitely were getting a lot of funds from the government, and I think that had kind of it put the thumb on the scale with the economy. So I actually think if you remove all COVID spend, you would have showed a recession. In my amateur opinion of being an economist, I'm not an economist, but now we're dealing with high oil prices. High oil prices again. I'm just pointing to look when oil prices are high, stock market suffers. Here's 2007, 2008. We dealt with a doozy of a stock market, a horrible stock market. And we need those oil prices to come down in order for the stock market to do better. And look, it's coming down a little bit. That's good. That's real good. And the VIX is still high. Okay. So we'll see where the market opens in about a minute. So I'm still into it. And I think the software space could really reward investors, but it's going to take a while, 2-3 years. But I think we'll be looking back like in 2029, looking back and going, man, can you believe Intuit was priced that low 3 years ago? Ricardo, good to see you. So I'm going to get into SLB and answer your question along the way, Ricardo. SLB is an oil services stock. So let's get into that.
If you don't mind, let me share the oil charts that I was looking at this morning.
You got the screen, sir.
Yeah, maybe together we can figure this all out. I am not an oil expert by any means, but this is the price of Brent. So most of the Brent goes through the Strait. So we've had a pretty large jump in that price. We're overbought. We're as overbought as we've been in the last 5 years, even in 2022. So that's Brent. And then we have West Texas Intermediate crude. And it usually trades at a little bit of a discount to Brent. But I'm going to go back 5 years. I'll let you guys think about some of what I'm talking about, and maybe together we can come up with a theory here. Once again, it's as overbought as it has been in 5 years. Now I'm going to take a look at them together. So Brent versus West Texas Intermediate crude. So Brent is on the top. West Texas Intermediate is on the bottom.
Mm-hmm.
Here's the delta. So what we saw was the price of Brent had moved up to a premium of about $7. And that is basically because the risk around that in the Strait of Hormuz is driving that price higher, where West Texas Intermediate crude is also going higher, but Brent was going up higher faster. And we haven't seen that since the end of 2022 and then during the COVID. And then we saw overnight or Friday, I guess this is Friday, we saw the price of Brent and West Texas drop down to under $2 per barrel, which is kind of interesting. So anyway, I heard some talk on a podcast on Friday about this, so I wanted to go out and plot it myself. And this is what I'm seeing so far. So what do I take out of it? I'm not an expert. Maybe some of you have some thoughts that are more well-versed than I ever thought about being. Okay, so let's go to your SLB now.
All right. And the United States is an oil importer. We've gotten a lot better from the mid 2000s, where we saw those really, really high oil prices. And we went from 60% importer down to 30 to 35% importer. So that's a good thing. So that way we can weather this a lot better. And I think the charts you were showing kind of show that difference. So SLB, what is SLB? Now, they were previously known as Schlumberger. And if you look at the spelling on that word, it's really a toughie. Now, I know how to pronounce it, or I should say I'm just copying how I heard other people pronounce it, excuse me. And these guys do services. So what are services, right? So an oil company like a Chevron, they have properties around the world, and they need companies like SLB to service those operations. Hey, can you go out and make sure that the equipment that is extracting oil is operating properly, the pipeline is sound, and so forth. And maybe Chevron has some oil rigs that they turned off 2 years ago. They're like, we're just barely making any money, and I'm just going to turn them off. Well, they might pick up the phone. I don't think they'll pick up the phone. They'll probably write an email and say, "Hey, SLB, we're looking at turning all these rigs back on. We'd like to get you guys engaged in that type of activity and pay you for it." So that's part of it. So just a lot of things that these guys are into, and the long-term ramifications of conflict are that maybe some oil assets get damaged through this conflict, right? You have these drone strikes and so forth. And one thing American companies do really well is they provide those services to the Middle East. They provide them around the world. And I think Venezuela is really going to benefit from the expertise coming into their country to help them extract more oil, put more oil in the market, get their government more money, and then that government hopefully will take it and do something good with it for the country. And SLB is exactly in that space. So as I was processing oil, and processing where we're at with the oil market, I'm like, okay, so this one may be kind of an obvious kind of choice, but you see that as we saw oil prices come down, SLB came down, and we've seen it fly up. Okay, it's down 1.36%, so I should be an SLB stockholder this morning because I had my buy order in. So I think it should have triggered. This thing pays 2.5% dividend. And I think this thing can go higher. I think it could go up to $60 per share. And it's not going to be like a long term, I'm going to own this thing for 10 years expectation. But I think it could be a stock that I'm up 25% a year because it's just the oil complex is just headed in a direction that's going to make SLB very busy. And when we look at their forecast, the forecast was already decent, but I think these numbers are going to get better. We can't have everything that's going on with oil and not have SLB increase their forecast. Hey, we've been getting more requests than typical. We've been able to raise our prices. We've been able to expand our margins because there's more demand. And these services are not like, hey, it's an easy service to go find. No, these guys know what they're doing. Okay. And there's some businesses that are in this space. SLB is probably the bigger one. There's also Halliburton, there's Pump, and there's a little safety in size. If you get a bigger cap, then I think you're going to deal with less volatility. P ratio 16, strong buy with a 12% discount because it's rallied so much this year, but it has had a little bit of a pullback. So that looks good. And I valued the stock and it looks good overall. So this is a stock that I think I'm a stockholder now. I'm going to check my portfolio when I kick it over to Daryl, but let me kick it over to you, Daryl, and then I'll come back to my valuation and I'll let you know if I'm an owner of the stock.
Okay. Okay, so this past week, every day has been lower. So you can see the volume was above the average Monday and Tuesday. Wednesday was right at the average. Friday was under the average. Wednesday and Thursday were right at the 50-day moving average. So they dropped below their 21-day moving average on the 3rd. That would have been last Monday, I think. And then they've been down each day and they closed below their 50-day on Thursday or Friday. Let me see there. Yep. On Friday. And then today they're opening a bit lower than they closed last week. I do see a long tail on this candle for today's trading. We've only been open 8 minutes. So buyers are stepping in here. I do see a bearish negative divergence. So we saw the price going higher, but the RSI peaking out at lower values. PPO was at lower values. That usually sets up eventually for this kind of activity to start taking place. The peak accumulation over the past year occurred on the 22nd of January. We had quite a bit of distribution and then accumulation started building. And then this past week, we were a bit more into distribution. Towards the end of the week, it looks like buyers were starting to step back in here. The money flow is now bearish and appears to be flattening off between Thursday and Friday. So I don't know exactly what to think about this, other than we are seeing a push toward lower prices on this one for the moment.
All right. So I am a stockholder now of SLB. So it's discounted by 36%. And I was able, what's, why do I do my own valuations is exactly what we're dealing with is we're dealing with higher oil prices. It's going to change the economy within the oil industry. And I could then forecast my cash that's going to come in over the next 4 years differently. That's why I have my model that I created, and I could change these things. And that's a qualitative decision, right? Of course, I think most people would be in the camp that, hey, SLB is probably going to do better. And the growth rate that they saw over the last 3 years is probably not representative of what's going to happen in the next 3 years. So I'm going to grow this year, 2026, by 15%, and then 7% for next year, the year that follows, and the year that follows, and then terminal value growing by 4%. And when I make those changes, the cash these guys are going to produce is really good. And I think that their PE ratio is going to go up to 18 because it's just going to become a stock that's more desirable. I think other investors are going to agree with the thesis that, hey, the oil industry is receiving a lot more cash, a lot more money, and they're going to spend it. They're going to spend it on SLB and so forth. So that's why I decided to buy into SLB. And I did sell out of one financials company located in China. So I'm going to be net neutral on the number of stocks I own. But that was my analysis over the weekend. And I arrived at, I think I want to buy SLB. Looking at their stock chart that I produced using my stock valuation terminal, it was, up here at a discount. And the oil industry is kind of a toughie because if you use average data, I think it could set expectations wrong, which is, oh, okay, they have kind of a smooth growth rate. No, they don't. Depending on where oil is, these guys are either making a lot of money or could be losing some money. And right now they're going to make a lot of money. So as you saw oil prices go up, you saw the stock price for SLB go up, and it came closer to fair value, but now it's kind of come back down. So I think it's a good time to buy into SLB. I own two other energy stocks. Chevron is my bigger position, and then Oxy. And those are great to have. But I wanted to add one more because if we do stay above $100 per barrel, oil companies are going to make a lot of money, but the rest of the market's going to suffer. So good stuff on SLB. Thanks on that, Daryl.
You're welcome.
Let's take a peek on our heat map here. Whoa. Man, what is going on here, stock market? And we had the time change, by the way, here in the United States. Maybe for those viewing outside the US, maybe you don't deal with the time change, but most of the states, I think Arizona doesn't change. I don't know if Hawaii changes or not, but we changed our.
Arizona has a corner in the northeast corner on the Apache reservation that does change times, but the rest of the state does not.
Interesting. Okay.
I used to live in Arizona for 35 years, so pretty familiar with that.
Perfect. So it looks like energy companies are the only things, kind of seeing a little bit of a stock rise, but not much of a stock rise. And healthcare, some of the healthcare companies are picking up a small bid. Staples, of course, it's expected, but nothing's really popping. This is encouraging. ServiceNow is holding its stock price. Intuit's going down. Uber's going down. Here's another thing I like about Uber, right? And fuel prices are going up. So But Uber doesn't pay for fuel. The drivers do. So all the drivers that drive an EV are like, yes, I'm glad I own an EV. And all the drivers that have, high consuming vehicles are probably like, man, I gotta get a hybrid or something that can get me more miles to the gallon because fuel prices are going up. But Uber doesn't get affected. Maybe travel is going to go down because airlines are going to have to pay for more fuel, um, and raise their ticket prices. And frankly, the consumer, here's consumer discretionary, right? The consumer is going to be a little more apprehensive on traveling. You can be like, well, travel services down 5%. I don't want to take a trip. I'm gonna wait to see what this economy is gonna do. 2026 is gonna be a hunker down year. We had a lot of fun in 25, a lot of fun in 24, a lot of fun in 23. Maybe we can pause, big vacation plans and wait to see what's going to happen. That's a psychology change. I happen to I observe in other high oil periods. That's what we saw is like, hey, everybody kind of takes a step back, doesn't spend as much, and so forth. So that's what I'm seeing out there. As expected, financials are down. Okay. And looks like there's a little more green pronounced here. Healthcare is a little greener. All right. And App Lovin's up a little bit. What stock is this here? Datadog up nicely. Go Datadog. All right. So it's going to be kind of a gloomy day. Not a good way to start the week, but maybe we'll see the stock market kind of push back and rally higher. We shall see. All right, so let's take a look at the chat here. Looks like we got a good number of messages popping up here. Peyton, good to see you. Yeah, I agree with you that these oil stocks, I'm not seeing like a huge pop in these oil stocks. So what gives? You would think that, hey, they're going to make a lot more money. I mean, last week we were dealing with a $90 per barrel price, and then over the weekend it was at 116. Oof. These guys, when they produce oil, they get to sell it at a higher price today. That's a fact. And over the 5-year, you see that last time we had a run up in oil, remember we saw that chart, 22. This stock flew up. Now, it's a combination of reasons. This thing doubled in value in less than a year. Now, the combination was COVID took the stock way lower. Okay. So it was COVID caused the oil industry to, suffer big losses because nobody was driving. The consumption went way down. So Oxy, got buried and then it recovered nicely. But it's still down. If you look at, probably this is a better compare. Back in 2008, it was way up here. So I think, Oxy could go to $100 per share. But it's, it's doing okay. 1.77. I'm not going to complain about that. But you're right that you would think with the energy price going up the way it's been going up, you would think Oxy would be up 10%. But maybe the market's like, well, we're not totally convinced we're going to stay high on oil prices. Okay. Well, makes this chart smoother. Let's stay on Oxy since it was brought up. Let's talk about Oxy a little bit here. And if you could show the charts on Oxy, I would like to see the charts selfishly because I own Oxy stock. So these guys, Occidental Petroleum, together with its subs, engages in the acquisition, exploration, development of oil and gas properties. Okay, got it. And these guys, there's an Occidental University that I think their founder started. Now, just about every oil company is in Texas, but California had a good number of them. but they've moved to Texas because I think that's where it's kind of like, if you're a financial services company, chances are you're in New York City or you at least have operations there. And Houston, Texas is the oil, you know, center of the world. So that's where they moved. But I think they had some history in California. No, actually, they were founded in 1920. Well, it doesn't say if they were founded in Houston. But there is a university in Los Angeles, Occidental University, that I believe has a connection to this oil company. All right, $54 billion market cap. Probably the most famous investor in Occidental is Warren Buffett. Its forward P is high, 40. Whoa. PE ratio looks pretty decent, 1.9%. It's gotten a little expensive according to analysts, but those analysts, right? Oil is you got to be quick to update your forecast because obviously the industry has really changed really in the last 2 months, like dramatically changed. So I think their forecast needs to improve. In fact, I'm probably not going to pay a lot of attention to their forecast because see how I can throw this out the window because they're only going to grow by 0.05%. I don't think so, guys. I think they're going to grow by like 10 to 20% top line growth because they're just receiving a higher price. It's not their decision. It's not their customer's decision. It's the market's decision to go higher. And Occidental will gladly take the higher price because when oil prices collapse, it goes the other way. Occidental has no choice. They have to sell their oil at a lower price or stop extracting it and putting it in the market. Right now, they're probably like, hey, crank it up. Let's produce as much oil as we can this year because we get a better price. Let's call it SLB. Tell them to help us get our rigs fully operational. Maybe even install a couple new ones. All right. So, and I don't know if quick question, complete aside, but have you seen any episodes of Landman?
I have not yet. It's on my list.
It's pretty good. I did see it. Now, it's pretty good, but it's not. It's pretty good. It's close enough. Now, I worked in an oil company a long time ago, and it was pretty cool because they gave us it was almost like a training program on the oil business, which I really appreciated because there's a lot of aspects to the oil business that I didn't know. And it's a old business, more than 100 years, old. And Rockefeller made his fortune in oil. And if you haven't seen a good documentary on Rockefeller, I encourage you to do that. And Rockefeller, here's a trivia question. Where did he start his company? Do you know that, Daryl? Where was his operation? Where did it start?
I'm not for sure exactly where it started.
Cleveland, Ohio.
Okay.
Isn't that fascinating? And if you study Cleveland, I've been to Cleveland a few times.
Was he selling heating oil?
A lot of refining capacity. Yes, that's why oil came into the picture is initially for heating, and then the automobile was invented and it began to use petroleum, and obviously that took off. But he started in Cleveland, Ohio, and at that time when he started, there was literally like 1,000 oil companies, and they were all competing against each other, and they were beating each other up. And his idea was, let's start buying these oil companies, and the rest is history. And he started to control most of the market. He became the wealthiest guy of that period. Government thought, we don't like a company having so much power, and they created laws that were personalized for Mr. Rockefeller.
Yeah.
All right.
They ended up making him richer because he split all those companies, and he had an owning interest in all of them. So they made him a lot richer than he would have been probably.
Here's an element to his story that would maybe surprise some. So here's the richest dude in the world. Okay. And he still taught Sunday school. He followed his religion and you know, big, huge man and so forth, and he still taught Sunday school. That's pretty cool. Anyway, I'm not a Sunday school guy, by the way. I don't. Anyway, back to Occidental. So 2026 slow growth. I think that's going to be underestimated by in a big way. And I think that these guys are going to flourish. If oil prices stay elevated, there's no way around it. Occidental is going to make a lot more money. Taking a look at my valuation for Occidental, and all you members know that you have access to this if you're advanced or gold or higher, and they're still discounted by 36% because when I look at oil, this is how I forecast oil companies because it's hard to know, okay, what oil price are we going to have next year? That's a tough one. I don't know if anybody can do that accurately. So instead, I take the 5-year average and say, look, I want to own Oxy because of times like this. When oil begins to fly up, I make a lot of money. And on average years, I know I'm buying at a good price. So I started buying at a good price and it's still priced well. If you look at their historic free cash flows, if you look at the PE ratio, and I'm going to move this guy because I think oil companies have all of a sudden become cool and a very good investment. And I'm going to change that guy and I'm going to change the date. And that's my valuation on Oxy. Now, Occidental takes more qualitative decisions than maybe a stock that's very consistent, like consistently growing. The oil business, you got to make those decisions based on what's happening in the market of oil. So that's where I'm at with Oxy. Let me kick it over to Daryl. I am really interested in seeing what the charts look like for Occidental.
So I don't know why I have a trim level set on this one, but I just updated because I don't own Oxy. But for trim levels, I use Chandelier exits, and it's up to 51.45, which would be a high water mark. So that would be my trim point if I was thinking if I held this one. If it started rolling over and dropped below this level, that's where I'd be trimming. As long as it stays above that level, I would hold it. And that keeps you in stocks longer than maybe you would otherwise. So that aside, we've got them trading above an upward sloping 21-day, 50-day, and 200-day. They're all in the correct order. We saw huge volume on the 2nd of March with the black candle. Means it opened higher and closed lower. And then the next 2 days, we saw downward prices and then a little bit sideways. On Friday, we saw very little price action. It opened and closed almost at the same exact price. So it opened at 54.20 and closed at 54.19. So almost to the penny. Look at all the volume. Wow. So people were working really hard and got a penny or so for their effort. So usually that means that you're starting to get a little bit exhausted, but I do see that they are trading a bit higher today. They've been in somewhat of an overbought condition since the 19th of February on this bounce higher where they gapped up. Here, I would say we have a flat RSI while the prices are going higher. To me, that doesn't look like a really bearish negative divergence at all. And PPO is in positive territory. Momentum is slowing down just a bit, and the accumulation, which doesn't get updated until the close, but it looks like for the past week we've been in a bit of distribution and the money flow is in neutral territory.
So what's the expectation, Daryl? Like on Oxy?
I don't really have an expectation necessarily.
If oil prices keep going higher, so will Oxy.
Yeah, that's true. I saw one person comment that the market may be betting that it doesn't keep going up, that it may be temporary. I don't know. I mean, I have no idea whatsoever of knowing. Let's take a look at this. I see a base form, then we had a handle form, then we broke out on the 19th. So let's take the price at the right rim of the cup, which would be 47.28. Got my handy dandy HP 12C calculator here. And then
That's
it looks like I have a low of about 38.52 or so. So subtract that from the price at the rim and then add it back. That would get us to about 56.04. So, I mean, it doesn't look like a blowout. We're only a couple dollars below that at the moment. So if you ask me about a price, I would base it on this cup with handle formation, and it looks like we'd be about 56. So not much above where we are right now.
excellent. And Daryl, we could still be friends, but back in the day, I was a Texas Instruments calculator guy. Looks like
Oh,
you're
I've
you're an
never
HP.
been, man. HP for hundreds of years.
A lot of people feel that way. I think that was like the brand loyalty is a little bit what you see with Apple. Like people really like Apple. Understood. Good
It,
product. Good product on the AP side, by the way.
it
Yeah.
was not necessarily brand for me. It was the RPN technology that they use. So it doesn't use any parentheses on their calculators. They use RPN, and that's what sold me on it. So whether it was HP that did that or Texas Instruments, I would have went with the technology. It just happened to be HP.
Yeah. All right.
So
All
I
right.
don't use parentheses.
Now I use Google Sheets. It's
Yeah.
the biggest calculator, and Google Excel or Google Sheets, right? Biggest calculator we can get our hands on. All right, good stuff. Thank you, sir. And a question was asked that I'm going to answer around Target, and I think it was Peyton, bullish on Target. So, good question. I'm going to get to it. So, energy's up a little bit. Consumer staples, which is where Target lives, operates in, and healthcare up a little bit. Okay. Broadcom's going higher. Broadcom did have a very good earnings report. And I mean, high level, right? This war and high oil prices can interrupt the AI build out because it's just, I don't know that AI is delivering. I think AI is great. I use AI. I've been benefiting from it. Great. But I just don't see it being a big giant deal right now. Like, oh my God, did you see? Like, I was kidding my brother in law yesterday. I was at my mom's place. We were working on her place. And I replaced a receptacle in her kitchen that went bad. It's one of those GFC receptacles. And I was finishing and I'm like, hey, John, isn't it be cool when I could just ask my AI app to fix this and it'll send a robot and, replace this receptacle. And, we don't have like use cases that are just that awesome and make your head explode kind of situations. I think it's cool especially for getting some things done. I think AI is really a productive tool, but it's not like, oh wow, man, it's really changing things. Oil's kind of proving that, which is okay. Deal with a high oil price. You're going to have to put a lot more money in your gas tank that you're burning each week. Well, that changes sentiment real fast. And I think the dollars being spent on AI will begin to get even more scrutinized. They're already being scrutinized. They're already being like, hey, wait a second. Why are we spending so much freaking money on something that might work? We're taking a big chance. So we'll see. All right, let's get to Peyton's question, which is Target. And Target's down 3%. So I think, let me put up his question. So I've been bullish on Target, fact. High oil prices. Okay, so let's think through that. All right, so the consumer, they used to put $100 into their gas tank, let's say twice a month. Now they're putting $200 in their gas tank twice a month. They're like, geez, I just took $200 of my disposable income, the money that I could have spent on something that I get a choice on. I still have to pay my mobile phone bill, got to pay for electricity at home. All those things are pretty much, those have to be spent. But maybe the money that I would have spent going out to eat, on apparel, things like that. Now, Target is a store where they don't have luxury goods. They have a pretty big pet food section, by the way. I noticed because it's like strategically located at my local Target next to the checkout, area. And I'm always passing by it going, people love their pets. That's a fact. And Target is trying to cater to that consumer. Of course, high oil prices, people that love their pets are still going to feed their pets. They're still going to take care of their pets. They're like children. And gift card section is awesome at Target because I find myself at the gift card department quite often. And that's really good. And then so on and on. So as the economy slows, I think Target could see a little bit of a pullback, but in general, it's still going to do well, I think, because they do have their, grocery section of the store. Of course, they put it toward the back so they get people to walk through and, like me, notice these things that I'm talking about. They have consumer electronics and the kind that I like to see, which is if let's say my wife needs something for her Apple device, like now we all got all this wireless charging, so cables, and that is a big plus, by the way. Wireless charging, I'm all for it. But back in the day when I needed something, I would end up at Target in their electronics area because they do have a bunch of, little gadget stuff. And you can pick up a few things while you're there. You can pick up a gallon of milk, a, electronic cable, and, a pack of socks. So all those things, are in play. So I actually think Target's a pretty good stock to have in 2026. Now, when to invest, I'm not currently buying more Target stock. I bought it here. Good move. It's up nicely. And I'm being paid a 6% dividend on my investment because I bought at the right price. So, could I throw more capital into Target? Yeah. If it gets, if it keeps getting sold off, it's not a bad place for me to throw some money at because I think it's going to go higher. It's going to go back to $200 a share over time, 2 years, maybe. And that's almost doubling my money from this point. If it comes down maybe to $100 a share, I would double my money. And this company is going to pay me a really nice dividend. What's wrong with that? Nothing wrong with that. So I am bullish that they're going to go to $200 a share. And it's not just, my spidey senses making the decision. It's that they had their business struggles, right? It's rational to see this stock suffer. Okay. They had struggles. They didn't grow their business. They went from growing their business to a contracting business. And I would say that you could probably study these years and go, yeah, you tried some things that really rubbed your customer the wrong way and you course corrected. They have new leadership, and that leadership is, I think, being conservative with their growth. So that's good. This is why you're conservative when you forecast your revenue. Is I don't know that they expected oil prices to be where they are, but now they have a cushion. They're like, okay, I think we can hit 3% growth, so we can still meet our forecast and not get destroyed on earnings. Our stock price won't get sold off harshly. So I think they're going to outperform this forecast. People still need to go to Target to buy a bundle of paper towels, go down the list. We're still going to buy the essentials for our homes, or we're going to buy food at Target. They have a very good snack section. So they have a very good, they have good sections. What they do is really good. Like our blender broke. It's been a little while, and I went to Target, got a new blender. Our Keurig, I upgraded the Keurig. Went to Target, and they offer the right product. It's placed right in the store, and I'm good to go. So I think this forecast is going to be, they're going to do better than this forecast. And you look at their profitability is really going to go up. So if Target executes this plan, this stock's going to $200 a share. And if the market lowers the price, that's not bad news. It lowered the price. That's good news. Great. Buy it. See it go. And now we're in the positive 1 year. I think psychologically that's a good thing. So I'm still bullish on Target. It's selling off. That could present an opportunity. And the other reason I'm bullish on Target is that Walmart's so overpriced. And these are comparable businesses. Walmart's much bigger, but if you go visit a Walmart and you go visit a Target, you're like, those are comparable businesses. I think Target's maybe a notch higher in quality, price, and all that stuff. Walmart is bigger and they provide really good deals. You go into a Walmart, you're going to get good value. The Walmart stock of 42 PE. Interesting. With a low margin business. The margins on Walmart are lower than Target. And Target's at what was the PE? 14.6. So I'm getting Target at 1/3 the PE. Dividend. I'm getting a 4% dividend on Target. I get a 0.8% on Walmart. Huge cap. And this stock has really worked for the last 5 years. Can't argue with that. But I think it's gotten really pricey. And again, the margins are not as good as Target. Target makes a higher gross margin, a higher net profit margin. So from every metric that I see is I think Target's discounted. And when I compare it to Walmart, I'm getting a really good bargain. Okay. So I'm still good with Target. But let me kick it over to Daryl. Maybe he could talk me out of it.
I'm not going to do that, but we're looking at 3 years worth of data, and we have a couple of downtrend lines here. This upper one was connected to these two spots where they tried to break out and could not. So then they traded for over a year below that trend line. We're going to zoom in here in just a moment. We'll take a look at this trend line. Then we have this lower trend line that they tested here and again here and broke out above that. So once they had gotten above their 21-day and then broke out above this lower trend line, that was a really good entry point. So let's go to 1 year, and what we're finding is that they are bumping up against that trend line once more. So they really need to break out above that, and with a sustained breakout. The 5-day is increasing, the 21-day is increasing, 50-day and 200 are both increasing. We had a golden cross where the 50-day crosses above the 200 on the 13th of January. I do see higher prices with lower momentum on both the RSI and the PPO, those are detractors from the price, running a bit higher at this particular point. They are trading below their 5-day moving average today. Accumulation looks really good. So we're looking at 1 year here, and they're looking at a 52-week high, and the money flow is bullish. So you have a couple bullish indicators. You have a couple of detractors with these divergences here. So they need to break out above this line. They're not attempting to do that this week, it looks like.
All right. Thank you, sir. And the app that I use, the stock valuation terminal, 35% discount. Here's the fair value. Stock's going towards this value. I think it's a real good position. And it's a good long-term position. If the market's going to keep giving me a nice discount on this business, I'm good. I think if we're in recession, Target's going to be all right. They offer their catalog, right? If you think about the consumer changes their behavior, right? Like, okay, we're in recession. I'm not going to go out to dinner and spend whatever $50 for me and my spouse, or whatever. And instead, I'm going to go to Target, buy stuff and cook it at home, and everything kind of ends up at Target, right? I'm not going to go to the name brand, or I should say, designer kind of retailer. I'm going to go to Target, pick up a couple of t-shirts and pair of jeans, pair of slacks, and be good to go. I think Target offers a good assortment, good value. Their stores are the right footprint. Their same store sales have been growing. I'm seeing the right things. Now, I'm not a big retail business owner. I own a couple retailers. Target's one of them. Kroger, they're a retailer of groceries. I'm beginning to buy into Sprouts Farmers Market because of similar story, by the way. And I picked up Sprouts at a good price. I'm a dollar cost average guy, and it's been a good one. It's early. I've been into Sprouts maybe a month, and picked it up at the right time. But these businesses, there's some of them that are, they'll do well for a year, 2 years, and I'm good with that. And I think Target's going to keep going higher. So thanks for asking. And that's where I'm at with Target. So the market, it's having a crummy Monday. It's a tough Monday. It could have been worse, by the way. When I looked at the market yesterday and I saw that $116 per barrel price, I took a glance at the pre-market. It was down 2% on the S&P. I'm like, oh, it's going to be a tough Monday. All right. So Mike, the dividend investor guy, bought several stocks today, banking on the long term. And yeah, we'll see what Wall Street thinks about high oil prices. Yeah, I think you may be right that it's being underestimated, but I could tell you that's a big increase in oil prices. If it sticks, it's going to be ugly, and oil companies are going to make a lot of money, which is another reason if the stock market is underestimating how these businesses are going to flourish, it's a good time to buy, because Oxy's up 2%, but some of these businesses, they're going to make a lot more money. Doesn't take a rocket scientist to figure that one out. And if the market's being a little lethargic on recognizing that, it's an opportunity for the investor that's paying attention. All right. So Ben 10, shout out for Ohio.
That was
Oh,
your
okay.
rock.
You were
That was your
answering. You're answering
Rockefeller.
on
Yeah.
rock. Nicely done, sir. Nicely done. I also saw the different story. I'll save it for another occasion. But
There's a really good documentary series called "The Men Who Built America,"
yep,
and Rockefeller is definitely one of those that's covered in that
yep,
documentary series.
yeah. The guys who built the steel industry, which was, oh man, who was that guy? He was out of Pittsburgh. All right, so we got a sharp calculator guy out there. Very nice, man. We're gonna start a religious war on our channel here. Sharp versus HP versus Texas Instruments, of a technology we used to cling to back in the day. Man, those days were different, right? You had a calculator, in my case, a calculator in the backpack, and we used to write on paper. Remember those days? And do a lot of stuff on paper. Everything was paper based, and now everything's digital. All right, so yeah, you're doing the right thing, Peyton, which is okay. You know, look at your holdings and what are you seeing going forward, reevaluate, and then make a decision. That's good. Good behavior. Michael Anthony, what's up, man? Yeah, I think that they don't have a huge assortment of food. They have a small assortment. They do have a good refrigerated food assortment, by the way, and they have enough fresh produce and stuff. I think what they're trying to do is they don't want to replace your Kroger, or in some cases, like, I'll just speak about Kroger. Um, what they're trying to cater to is you're out of milk and you needed this and you needed so you end up putting three things in your basket and you check out. Boom. That's Target. Or like my wife goes to Target and she'll ask, me and my sons, "Hey, do you need anything?" My last order was a pair of socks, refresh on socks, and then she got like maybe, I don't know, five things. That's Target's model. Walmart, I think Walmart has a bigger store footprint. That has its positives, it has its negatives. Bigger store footprint means higher cost and all those things that come along with that. I was in a Walmart a month ago, big store, and it works for them, right? Target, smaller footprint. So we'll see. We'll see. I think it's not about like, it's about where you're going to buy a stock. Like, are you going to get a really good discount? And is the business going to begin to do better? I'm not asking Target to put Amazon out of business. I'm just asking them to operate well, efficiently. They did make some decisions a couple of years ago that I think were controversial, and don't make decisions like that. Don't change the business like that. All right. Nice. Yeah, I'm sitting on my shares for Target. If it gets sold off, I mean, again, a bad economy is not bad news for Target because there'll be more shopping at Target. I think the consumer psychologically is, psychologically, if the economy begins to turn, you're not booking your next vacation. You're like, you know what? We're going to keep that money in the bank. And a lot of like consumers, I imagine, are like, they don't have the money to begin with. And like, okay, I'm not going to put that on my credit card. But the decision to go to Target or not is not kind of an emotional decision. It's a necessity decision. Like, hey, I'm going to a birthday party. I'm going to go to Target and buy a gift for this person, or in my case, there's little ones in my family, and I can't show up without a gift. I got to buy them a cool little present. It's fun for me to try to find a gift, a toy that this child is going to enjoy. It's one of the things that I like to do. So I end up at Target because there's not a lot of toy departments left. Toys R Us is gone, and that's where I end up. Or it could be, hey, I need some towels for my bathroom. Target. And it's a different experience than going to Costco. Costco's a commitment. That one, you have to be committed. You got to show up, show your membership card. Parking is like a little bit of a battle in my case. I don't know if it's different for you guys, but I know I'm getting such a bargain that I got to do it. I got to do it. But Target's easy. Get in, get out, buy my stuff, move on. Good return policy. They have a Starbucks in our Target, where at Costco you can get, how much is a hot dog? $1.50 or $2?
Costco's
outrageous.
$1.50.
That's the best deal on a meal I think you can think of, which is why that area of my Costco is always full of people waiting for their hot dog, waiting for their pizza, and they get a really good deal. So I think Target's going to be, I think it's going to be fine if we have a bad economy. I wouldn't say that about like maybe some retailers that are trying to sell up the prestige. Like, I mean, Macy's, I'm kind of dogpiling on that. It's going to get harder for Macy's. It's already been hard for the last 10 years, but it's going to get harder. Anything that is selling a product that is a discretionary decision, like, hey, should I replace my mattress? Well, you don't need it, so maybe you can put it off till the economy's better. Anything that's luxury, furniture, it's going to be tough. Furniture sales should be down if we have a bad economy because, yeah, the couch is looking a little dated, but you know what? It still works. It's, comfortable. It just doesn't look as nice, but let's wait for a good year and then we'll make the decision. So that kind of stuff. Home, like kitchen remodels, I imagine are going to go down if we have a bad economy. That kind of stuff, because kitchen remodels, I could tell you firsthand, are expensive. Bathroom remodels, expensive. Anything in your home that you're going to remodel and truly like change cabinets and appliances and plumbing and all that stuff, man, thousands of dollars. So that's where I'm at with that. All right. So looks like we answered the questions. Very good. All right. So market is not going to have a good day. Oil's moving up. That's good. All right. DJ, how you doing, DJ? What are the 5 stocks that will gain quickly once the war is done? That's a very good question. All right. So I'd like to imagine. All right. So Iran, U.S., Israel come to an agreement of some sort. They put their weapons down. We move on. So, 5 companies, 5 stocks. So for sure, some discretionary stocks are probably gonna get improved, and financial stocks are probably going to be improved. So those are I would look for stocks here and here. And it might be the right question, which is buy when the market hates a category and is discounting it like crazy. So start looking in financial, start looking in consumer discretionary, businesses that you really, really want to own. Measure your risk. If you go into travel, you're taking a pretty good chance, because if it's a prolonged war, I mean, these guys are getting It's hammered, right? These are the cruise lines, right? Yeah. And they're getting hammered. Well, if you see value, you can start, in my case, dollar cost averaging into this category if you want to be in there. I'm in Airbnb. I'm good with Airbnb, not selling Airbnb. But if anybody wanted to be a booking stockholder, well, maybe here's your chance. Maybe you wanted to go into RCL. Well, if it keeps getting hammered down, this might be a good category. As soon as the war is over, this is probably going to do better. Travel stocks are getting hammered because obviously travel into the Middle East is going to come to almost a absolute halt. I don't think even folks from the Middle East want to travel. It's like, hey, let's just kind of stay home. But I would say that in general, it's going to slow down quite a bit. I think Europe will see less travel. I don't know about Asia. I've never traveled to Asia. I want to travel to Asia, but we'll see. And I think domestic travel, I think what we saw when we had a bad economy in the US was instead of people getting on a jet and spending, $5,000-$10,000 to go somewhere really cool, they're like, hey, let's jump in our car, spend $1,000, maybe $2,000, and drive somewhere really interesting. So national parks started getting to be used big time, and maybe some lesser known places started to get traveled to. So that kind of travel might kick in. So I think this would be an area that would really respond well to the war. Ending is travel. Home improvement. Now that one I'm not going to point to. So I picked one there. Over here in financials, these guys are dealing with two things, but the one stock that came up last week, American Express, and I will point that out. I've been now tracking American Express because I looked at it, I think on the last stream. It's nicely discounted. It's been on a sell-off. Now, this whole travel is affecting American Express, right? American Express is the business travel card. It's also the card that big spenders tend to have. And if this war gets, settled, I think American Express could rally. And it's already a good price stock, in my opinion. So that would be a good stock to take a look at. So there's a couple of ideas. I don't know if they added up to 5, but let me turn it over to my colleague and see if you had a response to that question. Good question, DJ.
Yeah, I think you covered it actually pretty well. I don't have any specific names that I would be looking at in that case.
Perfect. Thank you, sir. All right. So I think we've covered all bases. Anything you want to mention that you're doing with your channel this week?
Let me take a look here. And the only thing I've really done this past week is just put out the my weekly review of stocks. So that's posted.
Perfect. Okay. So one thing that's happening with my channel and website, this is all alive to anybody. You don't have to be a member. You don't have to be a paid member of the website or anything, but I updated the super investor performance, and Manish Pabre, by the way, is killing it. And what's interesting about it is a year and a half ago, he was in dead last, and he's super concentrated. He owns 4 stocks, and he owned 3 stocks back here. But the stocks he owned were material stocks, and a year and a half ago, they were just getting destroyed. Well, now he's in first place. He owns material stocks, and he owns one petroleum transport company, and he owns an oil services company. So this guy's smart, but he's so concentrated. Even though he's super smart, he goes from losing 50% to gaining 72%. What's also interesting is Michael Burry at the beginning of 2025 was number 1 or number 2 on this ranking. his positions were excellent, and he sold out of those positions and he bought Lululemon, and that's exactly the consumer discretionary product that is probably being hit with this war, because yoga pants at $100 a pop, I'm sure a lot of consumers are like, well, I don't need a new pair of yoga pants, or at least a Lululemon yoga pants. I think I'll go to Target and buy some off-brand yoga pants. So Michael Burry went from first place to last place, concentrated. And it's kind of the lesson baked into what these super investors are showing me, which is if you're really concentrated, you could have a year that's like a personal record for yourself. You could also have a year that's disastrous. So if you're a young investor, it's maybe worth considering that. For an older investor like myself, I'm good diversifying, because even these guys that diversify, Howard Marks, 44%, he owns more stocks than I do. Like, he owns a lot of stocks. Kathy Wood is diversified and she changes her portfolio quite a bit. She's doing well. Tom Lee actively changes his portfolio. Tepper, he was near the top, very diversified. This guy's a little more concentrated. So I think there's some lessons there on, diversification and how many stocks an investor owns. So take a look at this on my website, rationalstocks.com. It's there. Anybody can access it. And you can go to each investor's portfolio. Let's look at Pa Bray, because he's number one. Got to look at number one. Here's Pa Bray, and he's in 4 stocks. Met Coal, Metallurgical Resources. These are coal stocks. This guy, 60%, 25. And then Rig, this has been a winner. Valaris, oil-based industry, 151. Nicely done, sir. Wow. Incredible. And again, he went from last to first. He very concentrated, big money on the line. When you look at, you could also look at like Mr. Buffett. I wonder how Mr. Buffett's doing. Mr. Buffett is, obviously he's invested in a lot of stocks, and he's in Chevron, he's in Oxy. I bought my Chevron. I worked at Chevron, a division that now, or a company that's now part of Chevron, in 1994. Okay. So my investment in Chevron started in 1994. I didn't copy Warren Buffett, but it's good to know that he owns Chevron. He also owns Oxy. And I have to say that I did buy Oxy after knowing that Warren Buffett owns it. And those positions have done well for him. He does have some red out there. He went into United Healthcare. He's kind of taking a lick in there. But that's where Mr. Buffett's at. So check out the Super Investor stuff on the website. It's available. And other stuff's available. Like I've got a blog going. I try to post there regularly, kind of like some analysis that I'm doing, and then I put it out on the blog. So take a look. If you want to be a paid website member, if you're a Super Investor member level, I'm near getting everything sorted out, but I'm going to issue out like free licenses to those members first, and then I'm going to kind of go down to advanced members at some point. But everybody else, if you want to get signed up, that'd be great. First month is free. Check it out. Give me feedback on it. I'd appreciate the feedback to make it better. And tell me what tools you think are lacking in online that as a long-term investor you'd like to see on this website. I would really be interested in hearing that. So, all right. So let's pop over to a new question that's in the chat from Shadow Guy. Am I still buying into 3M? I still have a plan to buy into 3M. Let me take a peek here. It's Monday. What's my plan with 3M? Yeah, I'm still buying into 3M. I think 3M offers good value. And when I think about 3M, right, they do put out some industrial products that we don't see because, a company might buy that product for their factory, for their operation, for the service they provide to consumers or businesses. So we don't see those products, but we certainly see others at our grocery stores, at Home Depot. And those are very consumable, very staple like products. So I like that. And I like the discount that's offered on 3M. So I'm going to keep buying 3M. The other thing I like about 3M, again, we'll look at Walmart 42. Look at this. Walmart's kind of holding its stock price quite well. People are comfortable with Walmart. I get that. But look at our 3M stock here, 17 PE. That's pretty rational. 2.1% dividend. Not the biggest dividend in the world, but it's there. 1 year, it's pretty much breaking even. Over the 5 year, this was the opportunity. Okay. See the pattern? We saw Target had similar scenario. 3M, if you bought here, you're doing well. And I can go down the list, right? This is what I'm looking for. I'm looking for a good value. Now, 3M, I'm buying it because I like the stock. I like the company. I like where they're headed. Historically, these guys have been just a huge success story with good products. They got sold off for good reason. They had their troubles, and their troubles are behind them. They're not stuck in those problems anymore. So I like where it's headed, and we'll continue to buy into 3M. Any thoughts on 3M, Daryl?
I've looked at it many times, but I don't have any buys with it. Let me take a look at the stock real quick. I know they were really struggling there for a while, so they had this big sell-off, but it looks like they broke above those trends and doing much better than they were. So let's just look at the 1 year. I haven't looked at this one in a while. They are trading below their 200-day moving average, which looks to be leveling out at the moment. They crossed below their 50-day on the 2nd of March. So dropping below the 200-day is a little concerning. They are getting close to being oversold. PPO is negative. I think I'd wait for a little bit of a recovery on this one before I would consider jumping in. They are really falling here this last week.
Yeah, but they're not alone, right?
No,
There's
that's
a
for
lot of
sure.
stocks. A lot of stocks have been getting hit. I wanted to take a peek at where we're at with the contest. Let's see here. Here it is. All right. So you can see this on the website, or you can see this. I think I have a different link as well. But we've got Genetic Smite with ALM, 104%. And at the end of March is when the first prize is awarded. So it looks like Genetic Smite, if ALM just stays where it's at, it's pretty much a lock-in for receiving a subscription to Stock Analysis. So congratulations, sir. And then I'll figure out what the prize will be on the second quarter. Oxy's doing well. OKE's doing well. Nebius is up 9%. I think this is CPRX. I'm going blank on that. Now, the one stock that is rallying higher today on, I don't know why, but I noticed it when we were kind of flying through it, was United Therapeutics, up 7%.
Wow.
Beautiful. Man, see, this is healthcare. High growth, high profit. These guys have, and these solutions matter. They are providing a treatment for these rare diseases. The treatment works. And if these people didn't have this treatment, they would die. So good stuff. They're going to buy back shares. These guys have a super strong balance sheet. I'm a stockholder. Glad to be a stockholder. I like their story and I like the money they make. I like everything about them. They got $3 billion of cash. They don't know what to do with. So they're like, hey, let's buy $2 billion of stock back because we keep cranking out more cash year after year. We crank out over $1 billion of free cash flow and we keep growing the business. We keep growing that top line. We got new patents coming online and we're going to keep getting bigger and bigger. So we got to get that cash off the balance sheet. Let's take some of those shares back and make our stock even more scarce. And then when we hit on this new drug that has been receiving positive results in all the FDA approval processing, the stock's just it's headed higher. And look at this PE ratio. We've got a high margin business cranking out free cash flow, cranking out profit, and you can buy it in a teens PE ratio at this time. And if they keep doing what they're doing, they're going to bring this PE ratio down to 12. Beautiful. Last thing, if they figure out that we're going to grow organs in the lab that are going to be transplantable to a human being, awesome. That'll be a real great option for many people. It'll be a big benefit to people, and I think they're going to be rewarded for it, as they should be. So United Therapeutics, nice job. I like this business. And I like their management team. If you listen to their earnings calls, which I did a video on these guys, and I think it's released to members at this point. I'm not sure when it's going to get to the general public, but I really like the tone they set. I like their passion. I like everything about them. Could I see them being acquired? Absolutely. But I don't think they want to be acquired. They want to become a $100 billion company on their own. And I wouldn't mind for that. I wouldn't mind taking my investment and multiplying it times 5 using a Texas Instruments calculator, if I may. All right, sir. Well, let's end the show there, if you wouldn't mind. And I hope things get better this week. I hope the war ends. I'm seeing more green. Maybe that's a sign that it is going to get a little better. But let's hang tight, right? Psychologically, right? This is stock investing. This is not like, hey, stock investing's easy and we figure out the right recipe and then sit back and make money. We need to deal with information and do what's right for that given period. And right now, I think you guys are asking the right questions. What stocks are going to be the good ones to buy once this war gets figured out? What kinds of that? Those are the right stories. Let's keep doing our homework, and let's not treat this as all bad news. If you're going to discount a company that I want to own, that's good news. I get a better bargain on it, and I'm going to take advantage of it. I showed 3 examples of taking advantage of the market selling off a business, and I'm making money. So let's keep doing that. Nothing wrong with it. We're not breaking any rules. So that's what I'll leave you with. Keep your chin up, and we'll be back on Wednesday. We're going to stream on Wednesday, and let's see how things play out. You know where to find me. Come to my channel, YouTube, members, go to the Discord, or go to the website, and we can connect. Leave me your thoughts. Tell me what kind of apps you want me to develop for the website, by the way. And if there's something that you think is missing, I'd love to hear that comment. All right, Daryl, great job today, sir. I wish you well.
Thank you, Victor. You too.
All right. Everybody take care. We'll see ya.
Take care. We'll see you Wednesday.